Hello friends, this is Raj Sastry from Raj Option Trading. Today is May 11, 2022. Hope you're all doing well. Market is very volatile, so we got to be very careful. In today's segment, we will take a look at stocks to avoid. These stocks have got very high negative cash flow, and many of these stocks are having challenges with the solvency, and companies also can go under. So with that, let's jump in and take a look at few stocks. Look, here we got a company, Carnival Cruise Lines. It has got a lot of debt and some solvency challenges. We should avoid such stocks and go after great candidates and buy them during this sell-off. So with that, let's go into details. So we'll start with a quick market update and look at top ETFs that we can buy during this sell-off, and look at stocks with a negative cash flow and negative margin, low solvency. This combination is very brutal, so we should avoid such names here. And then we'll quickly conclude and look at few stocks that we can avoid. So with that, let's jump in. Look, from a fear and greed index perspective, right now we are in the extreme fear zone at 19. So this tells you at this level we will have folks from the sidelines. They will start putting money into the market, and it can slowly start going higher. So that's why anytime market goes into extreme fear zone, that's when we can slowly start investing. That's the best time to invest, and you can have nice bounce back as you go forward. So if you have some money, I would say start putting some money into the market. If you are not confident about the stocks, you can go after some great ETFs that we'll talk about, and you could go after great stocks at very fundamentally good, sound, great stocks and buy them. So with that, let's jump in. All right, from a market update perspective, look, we got here inflation barreled ahead at 8.3% from 1 year ago. We are at a 40-year high. So this gives ammunition to Feds, and they can increase the rates. If they increase by 50 basis points, game over. Market will come down further. But if they increase maybe say 25 basis points and say they will be data dependent, then we have some chance of going higher. That's why we got to be careful here. And Wall Street is worried, and look, we closed sharply down even after 2 to 3 weeks downtime. We are still closing down, as you can see here. Dow Jones down, Nasdaq down, and S&P 500 down. So before the numbers came out, it was a little bit positive. Look, we had a little bit positive opening, but after the numbers came out, look, sell-off, big sell-off everywhere. So that's why you got to be careful here. So in the futures market, look, we are slowly going higher. Dow Jones up 95 points, S&P 500 up 16, and Nasdaq up 18, and Russell also up slightly. This can change overnight, but at least right now market is digesting this news about this sharp increase in the inflation, and looks like it's trying to go higher after the news is out, which is a good story. Looks like a lot of negative news is baked into the market. That's why it's trying to see if it can go higher. We'll keep a close watch tomorrow. All right, so let's jump in here and look at the major indices. Look, major indices are down, nice down here right from April. We are nice down territory. The moment it comes down so fast, so quickly, normally it looks for some catalyst to go higher. So we'll keep a close watch on this. But at these levels here, you could slowly buy some great stocks and great ETFs. Don't buy in huge quantity. If you want to buy 100, buy say 5. So that's the way to invest. When the market comes down here, go after the quality, not quantity. Same story. Look, S&P 500 up nicely here. Small uptick in the futures market, and same story in the other areas like Nasdaq down, and Russell 2000 also down. And look, gold is down big time here, trying to go slightly higher. Gold is a good buy when it comes down like this. Good hedging play here. Crude oil is trying to bounce, as you can see here. Nice uptick today. With all the uncertainties, crude oil is going higher. Bonds also try to go higher, but this can sell off, and interest rate came down slightly, which is a good news for stock market. All right, now let's jump in here and look at most active stocks. From a most active stock perspective, look, we got Apple at the top here. Apple is one of the great stock. As Apple comes down like this here, it's a great time to buy some Apple slowly and accumulate. This one will do very well. And then you got few more here. Advanced Micro Devices, which is one of my favorite here, also came down nicely. You could buy some AMD also here. And then you got, look, Ford is down big time here. You could buy some Ford for the long haul. And Nvidia, one of my favorite, you could buy this one also. And you got few more here. Look, when there is solid company like Microsoft coming down, you should go after stocks like Microsoft and buy. This is a well-run company. They will do very well. And for the folks who are buying beaten down names, you could buy some Intel. Intel will bounce back nicely as you go forward. But right now there is a lot of short-term pain, as you can see here. On the winner side, look, the gaming stock here, Electronic Arts, that's jumping higher here. I would slowly buy if there is a small pullback, but even up here, stock is beaten down, you could buy. And then you got a few more here which are up nicely. I would wait for a little bit pullback before I jump the gun here. And we got a few more here. Look, big loser perspective. We got Signature Bank here. You could buy some Signature Bank here. It's down big time. It's a great one, well-run company. We got Enphase Energy. This can come still down here, a little bit high valuation, but it's a well-run company. I expect this to come slightly lower than we can buy. Generac has been coming down for a long time. I would wait slightly. And same story, Tesla. Tesla is a good one here. If you have some money, you could buy a couple of Tesla and shove it away. It could be long-term good buy, but short-term pain. And Solar Edge, again a solar play here. It's also a good one based in Israel. You could buy this one also very slowly and accumulate. Look, EPAM system, after running very high, it's coming down slightly here. I would probably wait for a small pullback and then jump in here. And we got a few more when it comes to 52-week low. Look, we got some great companies. I would buy stocks like SPNY, Signature Bank. It's a good one here. And we got a few more here. So Lennar, one of my favorite here. Housing play, you could buy this one also. It's a well-run company. And we got a few more here. Look, we got SPG, Simon Property Group, as well as DHI. You could buy them also, both great companies. I like Generac, but Generac has been coming down so much. I would, if you want to buy, you buy slowly here. But this company has been dropping off big time. All right, let's jump in here and look at top ETFs to watch. So if you are a person who don't want to invest stocks, you're a little bit afraid to dollar cost average, then look no further. Look at the ETFs like QQQ here. QQQ is a great one here. I know it's falling off big time, but there's no single stock exposure. You could slowly buy 1, 2, 3 as the market pulls down. This will be a great long-term investment. I know a lot of people who just buy QQQ on the down days and then sell it later. They make some good money, and also they shove away QQQ in their long-term retirement portfolio, and it's done a lot of money for a lot of investors. So you could take advantage of this market drop off and slowly buy 5, 10 QQQ and shove it away. Look, even after this drop, this one is up big time in 5 years and 10 years. So you could slowly buy this company, buy this ETF here. Look, very low RSI 32, tells you it's completely sold off. It's 28% off from 52-week high. And then you got SPY. You could do the same thing with SPY. It's a great ETF. You could buy this one also, take advantage, slowly dollar cost average. And for the aggressive ones here, you could look at some aggressive ETFs here. I like XLV. It's not very aggressive, but you could buy this one also, take advantage, buy slowly. You will do very well. For the aggressive investors, you could buy some XLK. It's also good technology ETF here. It has done great in last 5 and 10 years, as you can see here. Look, 10 years, 440%. That's a great investment. And for the aggressive investors, you could look at SMH, which is semiconductors. I'm trying to see right here. Look, semiconductors right here. It's down big time, but look at the performance in the last 10 years, 668%. If you're afraid to buy AMD or Nvidia or some of these stocks, you could buy SMH here and shove it away. You will do very well. And for the folks who love biotech and healthcare like myself, you could buy some IBB here. It's a great one, great ETF, no single stock exposure. You don't need to worry about investing in a company and find out there is some FDA approval issues. It plunged down by 50%. No issue there. You could buy some IBB and shove it away in your long-term portfolio. All right, so as you look through in today's session here, most of the ETFs are down with the exception of energy, which is ticking higher. And then you got here TLT, which is treasuries or bonds going higher. And then you got safe haven gold is going higher, as you can see here. And we got oil going higher. That's the trend here. Otherwise, most of the other ETFs are down. And then you got US dollars, which is strengthening, as you can see here. US dollar has been going higher, as you can see here. That's causing some issue to the stock market. And US dollar goes higher mainly because interest rates are going higher. That's why dollar gets strengthened here. All right, now let's jump in here and look at top stocks to avoid. So these stocks, many of these stocks have got negative cash flow, negative margin, which is negative net margin, and low solvency. So when there is low solvency, that tells you this company can go under. You got to be very careful, and you should not invest because there are a lot of good opportunity to invest at this time. There is no need to invest in these stocks at this time. So with that, let's jump in here. Look, we got here the net margin here. Keep a watch on net margin. There are several companies with negative net margin. Be very careful of such companies. And look at the debt to equity here. Many of these companies, almost all of them have got high debt load here. So you got to be careful with all the companies with the red here. They have a lot of debt load. And then keep watch your free cash flow here. All these companies have got free cash flow negative and a lot of debt on the balance sheet, as you can see here. That's why you got to be very careful. And then finally look at the solvency ratio here. Whenever you see red in solvency or even yellow for that matter, that tells you, especially the red ones, they have this issue with the solvency. That tells you the companies can go under. So you got to be careful. So with that, I would say, focus on the negative net margin to begin with. Look, we got two right here. The Carnival looks like it's got a negative net margin, which is not great. Look, high negative net margin. It's got debt to equity, which is very high, and current ratio is below 1. That tells you they don't have enough money to meet short-term financial obligations. So with that, as you go further down here, it's got solvency challenges. Solvency ratio is negative. That tells you this company can go under also. And overall score is very low here. That's why you got to be careful. Even though for next year expectation high, with this much debt load here, $36 billion, and look, it's got free cash flow negative, and look, cost of debt is not too high, but it's too much debt load and solvency challenge here. I would not invest in such companies. And you could go further down here. We got a few more here. Look, we got RIVN. Even though there is a small bounce today, this one has got a lot of debt here. Look, negative net margin, as you can see here, and gross margin is also negative, as you see here. And look, it's got a lot of negative free cash flow here, $5.8 billion. And it's got solvency challenges, a very high negative solvency percentage here, or solvency ratio. So you got to be careful with such names here. And then you got a few more with solvency challenge. You can see right here. We got UUMC. This one right here. This one also has got solvency. Not this. Yeah, this one has got low solvency, but it's a positive, a little better than other ones here. And then we got a few more, as you see here. We got a couple more right here. We got Boeing, and we got RCL and Open Door. All have got negative solvency ratio. And look, all of them also have got a negative net margin. So you got to be careful with such companies. And look, Royal Caribbean as well as Open have got a very high debt to equity ratio. That tells you they got too much debt on the balance sheet. You got to be careful with such names. And finally, we got Norwegian Cruise Lines. Same story here. Look, this one has got a solvency challenge here, -24 solvency ratio. and look, it's got negative net margin. Company is losing money, and at the same time it's also free cash flow negative, a lot of debt on the balance sheet. And keep watch your companies like Norwegian Cruise Lines, because their balance sheet is not great. They're paying 15% interest rate on their huge loan of $12 billion. And same story with Carnival here. Look, CCL is right here. This one also pays a high interest rate, not the Carnival, the one before UUMC, that also pays a, let's say Carnival pays 4.30%, and the one right here, let's say BBD pays a high interest rate on their loan here. So you got to be careful with such names here. All right, now let's look at a couple more here. In general, I would be careful with all these negative free cash flow companies here. Look, even Amazon.com, it's a good company, but look, it's got negative free cash flow here. That's why you got to be a little bit careful here. It's a well-run company, but understand they got free cash flow negative. So companies like Apple, like Microsoft, Google, they all have positive cash flow, whereas Amazon has got negative cash flow. You got to be careful with such names. Instead, go after better ones. All right, let's now jump in here and look at more companies. So same situation here. Keep watch on the net margin. I don't like the ones with a negative net margin. Top of the list, we got Carvana here, car vending machine, negative net margin and high debt to equity ratio. That tells you they got a lot of debt. And as you see here, negative free cash flow here and $5 billion debt. And look, their solvency ratio is also very low here. So I would be careful with such companies here. And we got two more here, DIDI as well as New Holding. Both have got solvency challenges, as you can see here. And look, New has got high interest rate on their debt payments here, 15%. And keep watch on the buyback yield. Some of these stocks are diluting the share count big time here. Look, DIDI and New, they're diluting the share count big time. They're issuing more stocks, which is not good. That will dilute the share count. And then we got a few more with the challenges with the solvency here. We got PMT, RIVN, and ARES. All have got low solvency ratio here. You got to be careful with such companies. High debt on the balance sheet. And look, Sunrun has got a negative net margin also. So you got to be very careful with such names here. And we've got a few more with the red. We got Jinko Solar as well as WE or WeWork here. Both have got lower solvency ratios here. And look, WE has got a negative net margin, as you can see here, and both have got free cash flow negative and huge debt on the balance sheet. So you got to be careful there too. And we got a few more, as you see here. I would keep a watch on these names here and go from there. Look, some of the Chinese names here. We got EDU, same situation here. Not a great one to invest in. Look, it's also in solvency challenges here. We got Peloton. Look, Peloton also big time solvency challenge, negative 34 solvency ratio, not good here. I mean, that's actually negative 49 solvency ratio, not great. So you got to be careful with such names here. All right, so let's look at a few more here and go from there. All right, so list continues here. Look, we got a few more. We got SoFi at the top here. It's also a bank, as many of you know here. They got some solvency challenge, as you can see here, minus 10% and negative free cash flow and a lot of debt on the balance sheet. Company has not made money for investors in a long time, as you can see here. The list continues here, so I would say keep a watch on these names here and be very careful. And look, some of these stocks are look, we got Grab here. Grab looks like it's diluting the they have got a lot of cost of debt, 15% cost of debt, so you got to be careful. And some names like Coupang is really diluting the share count here. Buyback yield is negative. That tells you they're issuing more stocks and diluting the share count, which is not good. And look, we got two more here with the very high interest rate here. We got DDL and one more here, James River. Both have got very high buyback yield. That tells you these two companies are diluting the share count by issuing more stocks. You got to be careful with such names also. All right, so with that, in a nutshell here, at the present time, market does not like negative cash flow companies, and you should avoid such companies, especially when there is when these have got high interest rate or solvency challenges. Avoid them. Instead, go after better names. So from a stocks to avoid perspective, look at stocks like Carnival Cruise Lines or CCL, Rivian or CL, Norwegian Cruise Lines, Carvana, DIDI, Peloton, so on and so forth. Go after the better stocks and try to avoid these names here. So with that, thank you very much. Happy investing and trading. Please subscribe.